Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bloomberg Surveillance is about conversation. That's the way we do it. Right now, joining us without question, our interview of the day, Stephen Englander with Earned Credit, the Standard Chartered Bank, definitive at Citigroup for years on cross rates, absolutely known globally for the relationships that currency show. I want to cut to the chase and go back to Yale. Okay, you had Bob Evanson as your faculty advisor at Yale. Did you ever go to the Yale-Harvard tailgate games that were legendary with Evanson?
No, but he did send me to Passo Fundo in Brazil to look at their agricultural experiment stations and see what they were doing. His
was granular data, which is the way Steve Englander rolls. Take the Yale granular study, the Cowles Commission, Schiller and all that, and bring it over to how you make a call of 50 basis points in September.
I think the trick is to try and understand everything that's in the market and ask, why does the market think what it's thinking? What is the market logic? And then say, do I have a right to disagree with it? Do I think that there's something I know that the market doesn't know, and how comfortable am I with it?
Let's start on the dual mandate of inflation. Let's go back to Evanson, giant of Minnesota and teaching at Yale, iconic, and that's the American farmer. The images this weekend of farmers in Arkansas flat on their back. How pernicious, Stephen Englander, is the inflation now in America?
I think the perception is quite strong, and there is a justification. I'd say this, that if you look at some of the adjustments for technological progress, our computers are much better, but we don't use that much of their capacity. So, some of the softness that we sometimes see in inflation is sort of added on by the BLS. It's completely legitimate, but it's not what the price of coffee is, what the
or Arkansas farmers are seeing,
or inputs from Arkansas farmers.
Stephen Englander with us, the Standard Chartered Bank. We are commercial threes through the market opening and well into this 9 o'clock hour. David Gura in for Paul Sweeney. David,
you mentioned that you're sort of looking at all of these market factors as you come up with that forecast. What was it that led you to make this call? Was it the simple variable of just the jobs numbers that we got, or was there some other mechanism or variable that sort of made you feel confident in that?
Well, you also have to try and read the mind of the Fed and the incentives in the market and so on. And I think, I actually think it's the right thing to do. And one question I ask myself is, say they had known the data for the last 4 months. Non-farm payrolls the last 4 months has averaged 27,000. And because of the bias that you get from the birth-death adjustment, we think even that's overstated. Would they have cut? And the answer is into our mind, that they would have cut. And so we think that they're not going to commit themselves to making a series of cuts, but they're going to say, look, the numbers are softer than we expected. We're reading the numbers, and they justify cutting, but also a bit of catch-up.
We're in this moment where the integrity of government data is being cast into question more than it has been. Certainly by personnel movements, but also as you listen to the president's economic advisors suggesting that they're not capturing the labor economy in a holistic sense. How does that complicate your job as a private sector economist who's looking at the economy? Does it raise doubts in your mind? How does it sort of change the work that you're doing if that's coming about?
Well, we actually spend a lot of time looking at the data and trying to understand if they're legitimate or not. Like last year, one of our big papers, and I think we were one of the first, was sort of integrating undocumented immigrants and kind of saying there's a reason the payrolls are so strong, because they're getting work permits and getting picked up by NFP. So I actually spend an inordinate amount of time worrying about the quality of data. And I'd say this, that the riskiest thing you can do is believe people when they say you're the gold standard, because self-criticism goes out the door.
Stephen Englander with us here in a Fed call of 50 basis points. I want to take a little bit of theory here. The budget lab at Yale has been absolutely brilliant in teaching us about this legislation and about tariffs as well. I personally saw tariffs this weekend. A can of paint went up 15% out of the blue. Steve Englander, I'm in the camp. David Kelly at I want to say at Putnam, at JP Morgan, David Kelly writing about the income effect as well. We're all focused on substituting. Lisa's going to go to Costco. She's not going to buy coffee. She's going to buy Sanka. Baloney. To me right now, what's going on is a major income effect affected by purchasing power. This goes back to a guy named Hicks, folks, a guy named Slutsky. But the answer is we're being hit with a new purchasing power that's evaporating.
I think that's correct. And a lot of people understand it, in terms of oil prices, right? You were paying $40 to fill up your tank. Now you pay $80. It means one less trip with the kids to McDonald's in the week. With tariffs and import prices, it's more spread out and less dramatic, but it's the same kind of impact. All of a sudden, everything you see is a little bit more expensive, and you have to make decisions and prioritize your spending.
Field of Dreams. Will 50 basis points ease our pain?
Ultimately, I think yes. And let me be clear, because we think that they do 50 and then they pause, because GDP numbers aren't bad. Productivity looks like it's actually pretty good.
Rashir Sharma said that in the FT today.
And you look at the labor numbers as they're really mediocre, sluggish, softish. But as you know, I was at Lehman's in 2008. This is not a 2008 type of labor market. That's not a April 2020 labor market. It's a mediocre, sluggish, poor labor market. Where you probably should get closer to neutral, but nothing's falling off a cliff.
The chairman has talked about the oddness of that and the challenge of having a market like you describe. How much closer are we to figuring out why it is that way and why it continues to be? Is it just the simple sense of ambiguity about policies and their effects? Is it, as you hear from Scott Bessent or Kevin Hassett, things will take time to equilibrate or work themselves out? What do you make of the labor market, the state in which it's in right now?
Well, look, if I want to criticize the Fed, I'd say that they spend 90% of their time worrying about demand shocks. Uh-huh. And here we are talking about productivity shocks, talking about labor market shocks. And there's a lot of ambiguity in terms of how you interpret numbers when they come in, because you don't know if they're moving, what shock is moving them. So I think that's the big issue that leaves things uncertain, uncertain about how bad things are. So I think that, in some ways it argues that, you kind of know the direction, so you make a move, but you'd be very cautious. I mean, what if we're in 1997?
Is stagflation a word that is bandied about in the Standard Chartered offices? Is it something that you were thinking about or worried about at this moment?
It's always a worry, but, with labor markets so soft, and spending going to be soft, I don't think labor is going to be able to push wages up, so I think that,
he's irrespective of 1960s. He's so Yale.
Irrespective,
push pull.
Irrespective of the productivity story, I think that
okay.
Yeah.
Darda with a brilliant essay this weekend, and he goes back to nominal GDP. And I get it. It's a conundrum. Do we have terrible economic growth, but still buoyant inflation, stagflation, as Dr. Gura talks about here? Stephen Englander, is the real risk here that we get this wrong and we have dampened growth and quiescent inflation, where nominal GDP dips below 5%, ginormous number, dips below, dare I say, 4% or worse? Is that in one of your probabilities?
I think that, we all talk about AI all day long. And I think that that's going to be the real decisor for how the economy breaks. That if it turns out that we're, partly because of AI or other factors, that productivity growth is strong,
right,
everything's going to be fine.
But the Fed doesn't have that luxury. We can talk about it. We can go Yale, bring in Simon Johnson up at MIT. Rogoff was on the other day. It's a bunch of bow tie stuff. The Fed doesn't have that luxury, do they, to ponder AI and productivity?
Well, they should.
But I know
and spend more time on it.
What is this, Bloomberg prescriptive?
Okay.
What do you mean should? Krugman was on once, and I couldn't get him to say the dreaded S word, should. Englander's doing it. What's should got to do with it?
But I think, in practice, given the absence of knowledge, it just means that you sort of go slowly in the direction that you think the data are telling you. I mean, there's no straw here with which to make bricks. And you can critique the productivity data very easily as well. So I think that they sort of, you take a step, you see what happens.
Right.
Take another step, see what happens. If something bad happens, you stop or you step back a little bit. If it looks good, you keep going.
President Goolsbee wants to go. Yeah, go ahead.
I want you to jump in here and finish out the interview. We're having so much fun here, folks, with the academics of Dr. Englander. I really want to emphasize some of this stuff is incredible dynamics, moving parts. And David, off of that is this dreaded word ambiguity, which is we really don't know where we are or what's going to happen. Continue.
I will ask you to indulge me and do a little work for us here as we look ahead to this week of data. So we have these revisions. I'm curious how you're thinking about them. But also we had President Goolsbee on Friday saying he wants to see the inflation data this week. That matters to him. We've got to look at the inflation side too, he says. How important is that to you? Sort of how should we be thinking or framing the data releases that we're going to get this week?
Okay, I think the important thing about the benchmark revisions is we think they're going to be significant, maybe 750 to 1 million down. And the important thing there is there's no reason to think that things have gotten better since the March of 2025. As far as inflation goes, I think the real issue, so my shirt price went up because there's a tariff on shirts. I mean, you don't know how to gauge it. If it turns out that, say services inflation is heating up, stuff that is not related to tariffs is heating up, then there's a problem.
Right. What happens to the animal spirit? You mentioned 750 to 1 million. Most people are below that at, say, 400, 500. Yeah. I mean, Steve Englander's out on a limb here, folks, with what we're going to see tomorrow. We'll have complete coverage of this. And Stephen Englander, what does it mean for people's retirement plans / the stock market? If we get Englander rate cuts, is that good or bad for equities?
A little bit of bad news is probably pretty good for equities because it calms the market down and it sort of says, look, if you get your company right, cost of capital isn't going to be an issue for you. I think if things are really falling apart, like 2020 or 2008, then bad news is really bad news. But in many circumstances, a little bit of bad news is actually good news for equities. And I'd say this, that the equity, you sort of say, why are equities so strong when everybody thinks things are mush? It sort of makes you look at the productivity element again, kind of saying, well, wages aren't going up, but it looks like GDP is fairly strong. What's left? It's not going into taxes. There's only profits.
Bill from London emails in. He's with the Standard Chartered Bank and says, ask Stephen what it means for the rest of the world. How about a Standard Chartered question this morning for Bill Winters? What does all this Englander talk mean for Singapore, for London, and the rest of the Standard Chartered world?
In some ways, it's actually okay. I mean, there are two elements. One is that if you look at the AI game, if that's the game, you sort of say, okay, U.S. seems to be on the game. China might be in the game. Bunch of other countries trying to get in. Europe, not there.
Having some conferences.
On the other hand, the say U.S. GDP or say the Fed cuts by 50 basis points. Everybody else's interest rates go down by 30 to 50 basis points. And that's far more important to them than sort of saying, well, if Englander's right, there are 40,000 fewer jobs, so they're not going to buy Singapore exports. Right. The fact that they can get their cost of capital and the risk premium is down, I think is more important to the rest of the world.
Does Bill Winters know that Standard Chartered Bank is up 89.67% in the past 12 months because of Steve Englander?
Well, I think he can add like 4 or 5 decimal points to that percentage. But I'm not, from your mouth to his ears.
Yeah. Honored. We'd love to get a phone call with you tomorrow on your busy day, Steve Englander, when we get this data out. Dr. Englander is with the Standard Chartered Bank, and they're just thrilled to give you extended conversations there. That's what Bloomberg likes to do for Global Wall Street. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's a good news for Mark Geller as he's ensconced in London, where he probably avoided the hit of the summer here for Global Wall Street. Mr. Geller is Global Head of Bank Debt Capital Markets at Barclays. And this is a chat for Global Wall Street. The big song this summer, I know you didn't, were you in the Hamptons this summer?
Unfortunately not.
No, you weren't in the Hamptons. Okay.
I was on the West Coast.
Let me read you these trenchant lyrics because this is where we are in September. I'm looking for a man in finance, trust fund, 6'5", blue eyes, finance, trust fund, 6'5", blue eyes. That's the deep lyrics of this song. Are we in an M&A frenzy? Are we going in with President Trump, with deregulation, just with the way the stars align? Is your day-to-day activity right now nuts?
It's certainly picked up over the course of this year, and I think the first quarter was particularly busy when we think about the post-election momentum that we had at that time. Obviously, as we've drifted through the year, there have been a few risk events, not least, obviously, the tariff discussions that we all had during the course of April. There's been a lot of geopolitical risk, which have brought some headlines as well, whether it's on the European side, Middle East, India, Pakistan. So I think through the course of the year, there have been a few elements where issuers and also M&A prospective participants have had to think very, very carefully about the year. But overall, the risk appetite that we've witnessed has been very, very strong. So I think from an M&A point of view, we are certainly very constructive as we think about the progress over the coming months.
Are the clients coming to the banks like Barclays, or are you going out across the hinterlands of America, of continental Europe, and saying now's the time? Which dynamic is?
It's a little bit of both, to be honest. If you take a step back and you look at the financing conditions that we've had at the moment, the strength of the equity markets, obviously many measures across the globe at all-time highs, that's been very favorable in terms of using that currency for opportunities on the M&A side. And I think if you look in terms of the cost of capital right now, we've had rates relatively high. But I think as we've been discussing since the job numbers on Friday, and we've seen a reaction in terms of rates, the prospect of seeing rate cuts over the coming months should support some of that activity as well, in the same way that we had 3 or 4 years ago. So I think it's looking very, very strong as we prospectively look ahead over the next 3 to 6 months.
You enumerated a lot of the risks with which you've had to deal. How much of those have, if not resolved themselves, gotten to a place where they're more satisfactory to those who are looking to pursue M&A? So I guess, is there more of a kind of comprehension or sense of the regulatory landscape, for instance, now? Is there a feeling that things have calmed down, in effect, more than they were a few months back?
Yes, if you look at the regulatory landscape, I think certainly coming out of the global financial crisis for banks over the last 15 years, it's been about building up capital and thinking about where the risks may be. But if you look at the global bank space right now, capital strength is very, very high. Liquidity is extremely strong. Vigilance around asset quality very high. So I think you could argue that the banks are in the best position they've been for 20, 25 years. So that's very, very strong, the opportunity to lend and to support some of the M&A activity that we're likely to witness and have seen over the course of this year. I think as you consider some of those risk events, whether it's tariffs, geopolitical risk, or otherwise, certainly at those moments, there's a little bit of a pause. But when you look at the speed with which the markets recovered over that period, I think it's very conducive indeed.
How about the appetite for cross-border transactions? So we're at a moment here where there's a lot of ambiguity about tariffs and trade policy. I think a lot of business executives are kind of wondering what the future looks like in terms of them putting a footprint or a plant here in the U.S. Is that dampening sentiment at all, just the kind of confusion, or, again, I guess, sense of not knowing the way that this is all likely to play out?
It's certainly an element in terms of the debate, absolutely, and I think that's something that we have to look at over the next 6 months. But I think the confidence around where asset valuations are right now, it's a great opportunity to think about what your business needs and could achieve over the next few years. So it remains a very, very good opportunity.
I want you to define strategic for banks. I don't know if you've seen it, but a bank merger this morning, maybe you can't comment because Barclays is involved, but PNC of Pittsburgh is buying into the Denver retail market with First Bank. Okay, one small $4 billion transaction. Define the word strategic in conversations right now, not finance stuff like 6'5" guys with trust funds, but the strategic mandate that's out there.
coming back to my comments around where the banks are globally right now in terms of capital liquidity, the confidence looking forward, especially outside of the US where there have been issues in the past over the last 10 years, most of that seems to have gone. And so a lot of CEOs, CFOs, the boards can look forward with confidence and think about where they want to be over the next 5 to 10 years, what footprint might be missing from their businesses. And I think for so many banks, looking through the rearview mirror, having to manage your business, whether it's because you're building up the strength that you didn't have at one stage, or strategically thinking about what you need, or managing conduct issues as it may be, I think a lot of that is out of the way now. So the opportunity to look forward with confidence is absolutely there.
Mark Geller with us with Barclays. We continue here, Global Head of Bank Debt Capital. Over the weekend, I know it's completely inappropriate for you to comment on this individual bank, the Hong Kong, Shanghai and Banking Corporation. The headline from Bloomberg, HSBC's biggest shakeup in decade raises stakes for CEO. When people are shaking up, are you seeing tweaking at the margin across the entire, or are they saying, we're going to stay in this business, we're going to get out of that business?
So it depends. I won't comment on individual names, of course. But strategically, as I mentioned, it's very important to think about where your business will go looking ahead over the next 5 to 10 years. I think in particular, returns for shareholders are absolutely critical as well. So when you think about those returns, and the capital that you need to keep against them, where is it that you've got the best risk-adjusted return for your business, and where do you want to take it? So I think looking at some of those strategic changes that we've had across the banking landscape globally, it's within that lens I would describe it as.
Mark, thank you so much. Mark Geller with us, visiting from Barclays. Don't be thrilled to have you here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Henrietta Treyz with us in Washington. David Gurr is going to drive this conversation. I'm going to get one question in here, Henrietta Treyz, with Veda Partners before Mr. Gurr holds court. Henrietta, everybody's electric bill is up. Do Congress people, are they aware of the inflation out there, or are they removed?
No, I think they're acutely aware. And the American public is very attuned to energy prices, as we all know. This is just after gas. So it's absolutely going to be a topic of conversation, floor speeches. I think Democrats are tweeting about it constantly. Republicans are trying to talk about how there's a boom in AI, and that's what's going to generate a lot of economic growth. But the reality is that electricity prices are through the roof. So anybody made that trade has been doing really well.
Henrietta, Tom and I were talking about, we've got 22 days till this potential shutdown. And I gather there are two routes that the Congress could take here. And I know the appropriators, Susan Collins and Tom Cole, they're interested in kind of a short-term spending bill. There's an appetite among some members, and I think from the president himself for a longer-term bill that would take us to next year. What's your sense of the trajectory here, the way this is going to play out? Yes, over the next couple of weeks here, bearing in mind we've got a recess baked in there as well. But also beyond that, sort of what kind of spending bill we're likely to get if, in fact, we get one?
You know, it's going to take even more money this cycle to keep the government open. And that's something that Republicans generally don't want to talk about after, especially DOGE and the president's efforts to cut the fat on federal spending. The reality is the president has requested more money for the Department of Defense than ever before. We're going to be spending about $2 trillion just to keep the lights on. So there is a reaction function in Congress where instead of passing a big $2 trillion package just to keep the lights on, they end up splicing it into little pieces. And so that's probably what we're going to get going into the last couple months of this year. You'll get a short-term stopgap CR that lasts as few as like 3 weeks, sometimes they do, or into mid-December, just before Christmas. And the benefit of that for the minority party is to basically chop up the legislative momentum that the majority party might get. So you see this when either side is in control. You get a short-term stopgap CR that pushes you into Veterans Day and then Christmas, and you just do that over and over again. And you can tell that that's the strategy because the far right now is asking for a full year CR, which is historically anathema to them.
Henrietta, I read the Ezra Klein essay in the New York Times over the weekend. He's done a video audio component of that as well. But he talks a lot about the bargain that Chuck Schumer made back in March. He convinced members of his caucus to go along with the last spending bill. Ezra Klein, a longtime kind of progressive writer, opinion columnist saying that he supported that at the time. He understood why the minority leader was doing that at the time. But he said this time is different. And I wonder if you agree with that assessment, how much of a fissure you see within Democrats and how that's kind of compounding the risk or the odds that we're likely to see a shutdown this time around, that the Democrats simply didn't get enough out of going along with that spending bill last time.
Yeah, I think Klein's argument is really interesting. The one thing I agree with is that Democrats need to get their act together. I mean, they don't have a comprehensive message or a strategy. And frankly, I don't think shutting it down just to stymie Trump's forward march is necessarily a cohesive argument. You're going to have to put a lot more meat on the bones. I'm biased, obviously, because I cover macroeconomic policy, but talk about fiscal dominance and trying to stress test the Fed into, cutting interest rates. Talk about how you're about to take over the Supreme Court and force a ruling that allows the president to tax the American people. That's literally what we fought the British over. So I think there are really clear arguments, and Klein's saying shut it down, and we can do better than that.
Henrietta, one quick question here, and I'm sure we'll talk about it as we stagger to the election. Over a beverage this weekend, I was pontificating about the Virginia governor race. Earl Sears, a Republican, against Abby Spanberger, the Democrat out there. How's the Democrat doing there? Is Abigail Spanberger a new Democrat, as David Gura talks about?
Yeah, I think Virginia is a perfect example of where the federal spending cuts come in, whether you get an engaged population, whether or not Democrats turn out. That's what they need to drive. So as long as you're having that conversation, Democrats should, just by being in the minority when one party has control, they should pick up the House and make a real dent in some of the Senate seats, picking up North Carolina and some of the others. Make a real run at it in Joni Ernst's seats. There's a lot to do, especially in an out year and a midterm election cycle.
Henrietta, thank you so much for the Monday Brief. Henrietta Treyz with Veda Partners. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube. Stay
with Bloomberg all through the day for the history being made in France. Mr. Carroll at our Paris News Bureau. I think I take great issue, Stephen. I full disclosure, folks, I have family in Paris. It's all about Paris for Americans. Marseille is 16% the size of Paris. Paris is 30%, 30, of the French economy. Folks, it's like LA and New York combined in impact. Stephen, how does this political crisis play in Marseille, in Lyon, in Bordeaux?
Well, look, you're mentioning places in France where some of the more right-wing parties have greater strongholds. So many of the people who voted in those particular cities might also be wondering about why they don't see themselves represented more accurately in the government of the day. We're looking at a government split in, or a parliament rather, split in about three. The far-right National Rally Party is the largest single party in Parliament, although the way that French politics has worked is no other party has wanted to go into business with them to form a government. They wouldn't be able to on the current parliamentary mats anyway. But essentially, within those three blocks, that nobody has enough of a majority to govern, which is why we're heading towards our seventh prime minister since Emmanuel Macron became president.
Stephen, quickly here, I'm just curious what the flavor of this speech is going to be. As we talked about a little while back, Michel Barnier gave one of these speeches about a little less than a year ago. What are we expecting to hear here? What should we be watching for in that speech?
His message has been really consistent throughout, not only since he became Prime Minister or when he announced the budget outlines in July, or 2 weeks ago when he called this governance vote, or even if you go back as far as the 2007 presidential campaign when he was a candidate as well. It's about bringing the French deficit and debt under control. He's repeated over and over again this figure of the French debt going up by 5,000 euros every second. It's actually a really interesting example of how you try to communicate a massive, largely incomprehensible problem with debt to the general public to try to win support for them. But essentially he's failed in that mission, despite being very consistent over the years of his position that France needs to bring its public spending under control, needs to bring down its debt levels and bring the cost of borrowing under control, because it's set to take up an even larger part of the front budget debates to come. I'm looking at François Bayrou now on his feet, launching this debate which will determine his future.
3 p.m. in Paris, or Stephen Carroll will go into the evening there to give you coverage of the French government.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.